On the Investopedia Express this week, it's a rally, Sally. Tell your uncle, tell your aunt. December's just being December. Shut that bubble rat. The end of the year is nigh and stocks are making highs. With a rate cut on the menu, it shouldn't be a surprise. But let's be careful what we wish for because Sam Stovall is here to warn us what can happen in a midterm election year. Still, profits keep on growing. We can't help but be impressed. Let's dial in our forecasts on the Investopedia Express. Welcome back and welcome aboard. Monday morning here on the Investopedia Express, live and direct, coming to you from downtown New York City. Welcome to all of our viewers and all of our listeners around the world. We are live every Monday morning on the Investopedia Express, and stocks are rising, rally on, coming out of last week, right on into this week. Most markets in the green as we head into the beginning of the trading week. And the bulls are being bullish right now. And that's maybe because it's December. December, usually a very positive month for the stock market. But also, there's lots of things that are making the bulls feel very bullish right now, feeling emboldened. Stock valuations a little bit more reasonable right now. They've come down from those highs. We had a 5% drop in the S&P 500. We had some of the biggest stocks taking 15 to 20% drops in the market. Also, the economy is not exactly falling apart. We know we have a bubble up in unemployment. We're probably going to hear more about that when the Fed meets this week, and the labor market is definitely softening, but we still keep on spending. Holiday spending, again, record highs, surprise, and better breadth across the stock market, too. It's not just the Mag 7 and AI stocks, right? It is now you got healthcare stocks rallying, you got financials rallying again, you got small and mid-cap stocks rallying with the hopes of a Fed cut coming this week and more Fed cuts coming next year. So that's bullish for that sector. And for those smaller stocks, earnings have been strong, real strong. We'll get into that in a little bit with Sam Stovall and other things. And inflation expectations seem to be anchored right now. Yeah, we got inflation around 3% or so, but those expectations for future inflation, not crazy, not off the charts. And with lower rates coming, we'll see what happens with that. And what are you seeing technically inside the market? You're seeing breadth thrusts lifting the S&P 500, right? We talked about these breadth thrusts, these wide breadth thrusts, and these market breadth thrusts. When you have a lot of stocks rallying at the same time, not just a few of them, well, that's improving what we call breadth across the stock market. And you want good breadth. Absolutely, you want good breadth. Why? Because that shows you got lots of different sectors, lots of different stocks rallying across sectors. That's strength. It's like a basketball team. You want a lot of the players in double figures, lots of assists, lots of rebounds across the bench and across the starters. And when you have that, you have momentum in the stock market. And surprise, surprise, that's what we have right now. But also, we got, as I said, probably lower interest rates coming, quarter point cut expected this week when the Fed meets. We'll get into the big expectations for the week a little bit later, but lower rates, again, bullish for some sectors of the stock market, but be careful what you wish for because we've had relatively higher rates the last few years. And guess what? Stock market has done just fine. Absolutely just fine. So, we may get this quarter point cut. We may have rates a full percentage point lower next year. By this point next year, lower rates on the horizon. We've had a pretty good run in the stock market, and we're entering, of course, we're in that fourth year of a bull market. So we'll see if lower interest rates actually add some more pep to the step of the stock market, which has done really, really well over the past few years, despite higher rates. And we got another signifier. We got the bull steepener, our term of the week. The bull steepener, always informative, always telling us something interesting. And we'll get into that in a second. But that is basically when, according to Investopedia, right, when short-term interest rates are starting to get lower. For nearly 2 years, we had a deeply inverted yield curve. Everybody was worried that the yield curve would eventually lead to a recession. We never quite got that. But it's one of the strongest recessionary signals when you get that inverted yield curve. That's changing right now. The curve has surged back towards positive territory. It's steepening at a fast pace. It's doing so with what we call momentum. I was looking at this great chart from Grant Hawkridge on what's happening inside the yield, and you've got a bull steepener going on. That is a momentum signal as well. It's historically associated with the beginning of an expansion, not the end, and it's translating into higher commodity prices. Commodities have been kind of depressed for a while. They're starting to surge again. When you got the bull steepener, right? When you got the yield curve, when you got it going positive, and you got a bull steepener and commodities rallying at the same time, sometimes that is a signal that we are in for economic growth. And economic growth, it could be a very big positive for the stock market, not just here, but around the world. And hey, it's been a pretty good year for the stock market around the world. So you look at the CRB commodity index, you see the all that measured against the yield curve and the bull steepener there. That tells us something very interesting is happening with economic growth around the stock market. Looking at companies in motion, and something that kind of came across the transom, across the news wires about a week and a half ago, is that Walmart is making a move to the NASDAQ stock exchange. That will happen this week. NASDAQ making the move from the New York Stock Exchange, where it's been for decades, over to the NASDAQ, which is kind of interesting when you think about what's happening inside the exchanges lately. They're all growing. They're all trying to get more and more listings. That is the business of being an exchange, but they're also venturing into new territory. When you look at Polymarkets and the tie-up with ICE, the New York Stock Exchange owner there, that's very interesting. CME obviously tying up with some of the betting markets there. But when you look at this move, Walmart making the move over to the NASDAQ, aligning with its growth. And this company is not just your biggest retailer in the world anymore. This is a high growth company. And if you look at Walmart's stock compared to the NASDAQ over the past few years, it shows you it's pretty much a growth stock, and it wants to be listed among other growth stocks, which means it could be added to some indexes soon, some NASDAQ indexes, and also all those big ETFs that compromise some of the NASDAQ's fastest growth stocks. Very interesting move within the markets here. The biggest retailer in the world switching exchanges again, taking effect this week. Let's get set up for what will be a very busy week ahead. And it's all about the Fed this week. Again, the Fed beginning its two-day meeting on interest rates tomorrow, Tuesday, heading into the interest rate decision on Wednesday. About a 90% chance the Fed will lower rates by a quarter point at that meeting. That's pretty well expected, and that softening of the labor market has definitely contributed to that, along with a little bit of creeping inflation. But what's going to be interesting is the press conference after the Fed decision on Wednesday with Fed Chair Powell. Again, last Fed meeting of the year, but let's get into what's happening the rest of this week. Monday, sort of the end of the earnings season coming our way. End of the earnings season coming our way this Monday. Toll Brothers reporting, among others. And on Tuesday, again, the beginning of the FOMC meeting. Again, last meeting of the year. Some earnings coming out on Tuesday as well, including AutoZone, GameStop. We'll watch out for that. The NFIB Small Business Optimism Index also for November. Small business is not that optimistic. When you look at the ADP payrolls report, we've seen small businesses shedding jobs and not that confident about the future of the economy, where it's an interesting signal to pay attention to. Again, Wednesday, the big day, the FOMC decision on interest rates and the press conference with Fed Chair Powell. But we're also going to get the summary of economic projections from the Fed on Wednesday. That is the Fed members' projections for the growth in the economy, for inflation, et cetera, but also the dot plot, the most boring yet the most important chart in economics and finance. That comes out on Wednesday, and that shows us where Fed governors think and members of the Fed think interest rates should be a year from now. We showed the dot plot a little bit earlier. That dot plot shows interest rates heading down and to the right, maybe a full percentage point lower at this point next year. Thursday, we'll get the U.S. trade deficit for the month of September. Again, very old data, but we will see the impact of tariffs when we get those numbers as well. Earnings from Costco and Lululemon, among others. And then Friday, we round out the earnings week and pretty much the earnings season. So that is what is on tap this week, but it's all about the Fed. We'll be locked into that decision. Follow Investopedia and our news team for full coverage of that, and we'll be across that on our social media channels as well. All right, let's get to the indicator of the week. And with all this optimism about the economy, it's interesting to see what's happening with cardboard box prices. One of those odd indicators that my friend Jeff Kleintop at Schwab taught me to look into, and he watches pretty closely. The demand for cardboard boxes, especially corrugated cardboard prices, is something very interesting to watch, especially as there is optimism around growth in the global economy. But if that's the case, then why are cardboard box prices falling? That is something we've been watching pretty closely. And cardboard box prices have been falling. It's been a cyclical decline potentially over the last several months, really since the last couple of years. We've seen this, and there's many reasons for why that might be happening. Maybe it's efficiency in packaging. Companies are getting better at packaging. Maybe it's industries that we're used to be hot or cooling a little bit in terms of shipments. That could be automotive and durable goods. That could be impacted by the pandemic. That could be just weaker investment in those industries, trickling down to fewer cardboard box orders. Could be early signs, as some people say, of stagflation or potentially down the road a recession. And maybe it's supply chain stress. Maybe it's all of these things, or maybe it's just a more cautious outlook from businesses and consumers, and maybe that's what's been pushing these prices down. But cardboard boxes and corrugated paper prices, one of those rare but important indicators to pay attention to outside of the big picture numbers, and that's something we're going to be watching pretty closely. All right, we got Sam Stovall, the Chief Investment Strategist of CFRA, dialed in here. Wasn't easy, but we got you. Good to have you on the Express, my friend.
Happy to be here, Caleb. Thanks for your continuing to try.
All right, well, let's play a little signal or noise, because you're so good at helping us differentiate between the two, especially when it comes to the market and a lot of the noise around the market. So let's start with this. Gold, the best performing asset of the year, up nearly 60% year to date, Sam. Stocks are up almost 20%, yet you have Bitcoin, the ultimate risk asset, down about minus 2%. Risk seems warped right now. Is that noise or signal, in your opinion?
Well, I think that we've had a series of signals, starting with the near bear market that we experienced from February 19th through April 8th. We got back to break even after that near bear market decline on June 27th. And history then tells us that we usually advance for another 4 months, rising about 10.5%. Well, it was 4 months from June 27th to October 28th. We were up 11.5%. And then history said, be prepared for another decline of 5% or more. We experienced the most minor of pullbacks, 5.1%. And if we end up recovering all of that, and we are less than 1/3 of 1% away from a new 37th all-time high of this year, history would then imply that we have another 3 months of upward movement, with the advance averaging about 8%.
Yeah, well, history and seasonality are important, and in your note today, you point out how quick the snapback was from that 5% dip a few weeks ago. Sam, the rips and the dips have been much faster over the past few years. Is that a signal, or is that just noise, or is that just the way the stock market works these days?
Well, I think that things do change in the stock market, and it used to be that it would take us 4 months to go from peak to trough on a decline of 10 to 20%. And then 4 months to get back to break even. Well, it took us about 3 months to go from peak to trough, 2.5 actually to be exact, and then only about 2 months to go from the trough back to the all-time high. So it's a lot quicker. And yes, some rules do change. Caleb, I'm sure you've heard of the rule of 18, which said that the PE plus inflation should equal 18 in order for the market to be fairly valued. Well, that actually became the rule of 20, then the rule of 21, and now people just don't pay attention to that rule anymore because of AI and the changes that have occurred in the marketplace.
Yeah, rules are meant to be broken. Plus, you have, when we look at volatility, the VIX used to be one of the most important things that we would track, but now, because you have these 0 days to even options, all these different ways that speculators and traders can bet on outcome, especially over the course of a day, it really sort of changes the timeframes, doesn't it?
Yes, it does, but I don't think that volatility, in a sense, has been repealed. We are entering into the midterm election year, which by far is the most volatile of all 4 years in the presidential cycle, with the average drawdown being more than 18%. So while we did get a pretty sharp decline in 2025, from which we recovered quite nicely and are up nearly 17% year to date, we could end up with a good 2026, but I think it will be a volatile one.
So that sounds like more signal than noise. That actually is proven by history. Midterm election years, and especially in today's political climate, nothing seems easy and nothing seems like it'll happen quietly. So we'll definitely be paying attention to that. All right, here's another one for you. Markets outside the U.S. outperformed by a long shot the U.S. market, the U.S. stock market so far this year. Some of that may be tariff and policy related. Some of that just may be because capital seeking other places this year. Is that signal or noise to you? Do you expect that to be the case going forward?
I think it's more of a signal because we started the year with the developed international index trading at a 20% discount to its 20-year average relative PE ratio. Mid caps were off about 30%, small caps still trading at a 35% discount to the average 20-year relative PE. So there were a lot of areas other than large cap tech that looked very attractive by historical perspectives. Also, because we had a softening in the value of the US dollar, that tends to magnify earnings gains, price improvements for the international marketplaces. And so I think that we could end up seeing that continue as more press is directed toward international opportunities.
Yep. We'll keep a close eye on that one, of course. And then you have this disconnect, and it's not something that necessarily shows up in price trends for our market technicians out there. But I know you look at the fundamentals, and you have an overall holistic view of what's happening out there. You got consumer confidence near all-time lows. You got a stock market near all-time highs. At what point does that disconnect actually disconnect the stock market? And is it all just about spending? We may feel terrible, Sam, but as you know, we keep spending, and we're going to break records again this holiday season.
Well, there's an old saying that consumers stop spending only when the banks stop lending. And so the banks continue to lend. Consumers, even though they are concerned about the changing policies that seem to be surrounding them. But at the same time, we got a pretty good read on back to school sales, and now expectations are fairly strong for the holiday season. So I think consumers will continue to spend. And so with the prospects that the economy is not headed for recession, I like to say that bull markets don't die of old age, they die of fright. And what they're most afraid of is recession. But when you look at the indicators that the NBER, National Bureau of Economic Research, considers when deciding whether we are in a recession or not, none of them at this point is pointing to any kind of softness.
Yep. All right, let's go out on this. Your price target for this year was 7,000. We're a 9 iron away from that, Sam. But for next year, 2026, you got it at 7,400. That's about a 6%, implies about a 6% gain. Take us through the end of this year and into next year. What brings you to those numbers?
Well, almost like a Star Trek tractor beam, you might think that the market is going to be pulled toward that 7,000 threshold, which is certainly a very important indicator. I think that with earnings growth expectations at about 13.5% for 2026, 14.5% for 2027, optimism certainly will be there. But because of the uncertainty surrounding the midterm elections, and in those election years, when you have a wave, meaning that the president and both houses of Congress are the same party, that tends to increase the volatility because it accentuates the uncertainty as we head toward those midterm elections. Also, we are trading still at relatively elevated valuations, not as high as we were on October 28th when the S&P technology sector was trading at a 73% premium to its 20-year average PE. But of course, some people say we should really only be looking at 10 or 5-year averages because of the duration of the impact of AI on technology and on the market. So in that case, we're still trading at a minor overvaluation. So I would tend to say that from a historical perspective, volatility could cause us to sort of spin our wheels for the first 3 quarters of 2026. But I remind investors that from October 31 of the midterm election year through October 31 of the year after, the market has never declined since World War II, and the average gain was 16%.
Yeah, history doesn't lie, and you were so good about putting it all in perspective for us. Sam Stovall, the Chief Investment Strategist for CFRA. Thanks so much for joining the Express.
My pleasure, Caleb.
And, and thanks to all of you joining us, hanging with us today on the Investopedia Express Live every Monday at 10 a.m. and on demand on your favorite podcast networks. Wherever you are, stay invested and stay warm. Cold out here in New York City, and we will catch up with you and talk again a little further on down the line.